Problem 5.1. So I copied the information over, so I don't have to type it while I'm reading it. But let's see. Since its 100% acquisition of Dancer Corp stock on December 31st of 2012, Jones Corp has maintained its investment under the equity method. However, due to Dancer's earning potential, the price included a $40,000 payment for goodwill, which we don't really care about right now. They're just giving us some extra information. At the time of the purchase, the fair value of Dancer's assets equaled their book value. On January 2nd of 2014, Dancer Corporation issued 10-year 7% bonds at a face value of $50,000. The bonds pay interest each December 31st. On January 1st of 2016, Jones Corporation purchased all of Dancer Corporation's outstanding bonds for $48,000. The discount is amortized on a straight line basis. Sorry, I was working ahead. The discount is amortized on a straight line basis. They've been included in Jones' long-term investments and bonds account. Below the trial balances of both companies on December 31st of 2016. So, Dancer originally issued the bonds to outside parties on January 1st of 2014. Then, after 2 years had gone by, Jones purchased all the bonds for $48,000. All right? So, they bought them for $48,000. They have a face value of $50,000. They only paid $48,000. So they have a gain. This is a gain. Okay, and it's going to be treated as a gain on retirement in 2016. All right, now also, this is not part of the question. All right, we're supposed to do the worksheet entries for the debt. The worksheet elimination entries, I should say. Just for the debt, that's all they want to know. And then the consolidated income statement for 2016. All right, so on Jones's books, this is the parent. And these entries are not part of the answer, all right? I'm just making sure y'all know what happened during the course of the year. All right, on January 1st, I don't know what just happened there. On January 2nd, of 2016, when they bought the bonds, they're going to have investment in bonds for $48,000 and cash went out the door. All right, and you can indeed see they have an investment in bonds right here under Jones Corp. Okay. Then when interest was paid at 12/31 of 2016, they received cash for the interest that was paid, and that is based on the face value. So that's going to be the $50,000 times the 7%. All right, or $3,500. All right, I'm going to skip a line. They're also going to have interest revenue or interest, let's see what they like to call it, interest income. They're also going to have interest income. And you might notice if you look down here, their interest income is for $3,750. So why is that? Well, this $2,000 difference, that's basically a premium that when they bought the bond, they paid less. That's called a premium or discount, whatever. But they have to get rid of it, okay? This has to go up to the $50,000. Well, that means I have to debit the investment, okay? When you're the purchaser, you don't record a discount or a premium. They actually bought them at a discount. But you don't record the discount or premium. You just make the entry directly to the investment account. And this has to go up. And they said it was straight line. So the straight line amortization is going to be the $2,000. And there's 8 years left. All right. It was a 10-year bond. 14 and 15 have gone by. So 8 years are left. All right, and I have to debit for the $250. So my interest income is $37.50. All right, so those are the entries that were made during the course of the year on Jones's books. All right, on Dancer's books, at 12/31, they're going to have interest expense and cash for the $3,500, okay, that was actually paid. They were sold at face value, so they don't have to worry about any discount or premiums on their books. All right, so remember, these are just the daily entries on each separate set of books. All right, so now for the elimination entry for the bonds, that's all we're doing. It's just the elimination entry for the bonds. Okay, the investment has to come off, and then they also have bonds payable. Do you see the bonds payable here? This has to come off. Oh. Why is it doing that? Oh, because it's a picture. It's like, let me highlight in the picture. Okay, so this bonds payable has to come off. It has a credit balance, so I have to debit bonds payable. All right, that's for $50,000. And this one's going to be kind of wonky because I'm going to just do them as I run into them. Related to that is this $48,250 of the investment in bonds. I have to credit that to get it off. All right, so that's $48,250. And then as I come down, I have interest income that has a credit balance, so I have to debit interest income. And then I have to, I'm sorry, I'm crazy. It has a credit balance, so I have to debit interest income. And then interest expense has a debit balance, and I have to credit. I'm not sure if I said that right or wrong earlier. All right, and then I'm going to sum these up and see if we're equaling out. All right, see, we're still off here, and we're off by this $2,000 gain. All right, so this $2,000 gain has to go on the credit side, and it's a gain, so it makes sense. Now I balance out, and this is gain on retirement of bonds. And that's the only entry they want. That's the only journal entry they want. So this is actually what's required. All right, and then I need to do an income statement. I'm not going to do a whole title and all that. Y'all just know there's a title up here at the top. All right, so we have sales, cost of goods sold, that equals gross profit. All right, and then we have other expenses. And then we just added in this gain. All right, so let's see. Our sales are $2,500,000 plus $540,000. Cost of goods sold is $1,000,000. Oops. $1,000,000 plus $405,000. Subtract that. Our other expenses are $720,000 plus $106,000. Our gain is $2,000. I'm going to do gross profit minus the expenses plus the gain. And that is our net income. And that is it for number 1. So that was pretty short and sweet. And remember, the stuff at the top you don't really have to do, but I think it's really important that y'all know where those numbers are coming from. All right, that's it for that one.